So, where's my, do you have a script?
Mark, where's the script? Where's the script?
So I think we have a quorum already, so why don't we start with attendance?
Dababne?
Here.
Dababne here. Allen? Asajian? Bonilla? Bonilla here. Brown? Brown here. Chow? Gatto? Gatto here. Hadley? Hadley here. Kim? Kim here. Lowe? Lowe here. Ridley Thomas? Stone? Stone here.
We have a quorum. Welcome, everyone, to the first meeting of the Banking Finance Committee. We also want to welcome our newest member, Assemblywoman Bonilla, will be joining us in lieu of Assemblymember Perea, who is no longer part of the institution. So we welcome you to the committee. Thank you. Today we have one bill. I will present AB 268. So actually, let's see, we'll hand it over to Ms. Bonilla, if you wouldn't mind, on your first day. And following that, we'll be having an oversight hearing. And look forward to including as many of the panelists as possible today. We are stretched for time, so before we start that hearing, we're going to do AB 268. But I will ask all presenters and speakers today to please abide by the 5-minute rule, and we will be a little strict on that. Thank you.
Thank you so much, Mr. Dababne. I look forward to hearing your bill.
Thank you. Chairwoman and colleagues, AB 268 is the first step to address an issue that I began looking at last year. Last year, I started a series of stakeholder meetings to examine the California Finance Lenders Law. CFL allows various types of consumer loans, including small dollar lending activity here in the state. These stakeholder meetings continue, and subsequent to hearing this bill, we will conduct a full hearing on the subject of CFL reform. AB 268 provides that a CFL licensee shall be examined at least once every 48 months or sooner if deemed necessary by the commissioner of the DBO. This is a similar authority that exists under other licensing law administered by the DBO, including the Residential Mortgage Lending Act. Later this year, the Consumer Financial Protection Bureau will release rules further regulating short-term loans. As this bill moves forward, it will be a vehicle for the reforms to our short-term lending laws and address issues within the law that will be raised by the CFPB's actions. I commit to bring this bill back to this committee in the future to review any additional changes that occur. I respectfully ask for your aye vote today.
Move approval.
We have a motion and a second. Those in support? Anyone wishing to speak in opposition? Any questions from the committee? Seeing none, we have a motion and a second. And is this a do pass to appropriations? Let's take roll. Oh, do you want to close?
I would just like to say that I'm looking forward to having this bill be a vehicle for further progress on this issue. And like I said, after the conclusion of this vote, we will have a full hearing on the matter. And I encourage as many of my colleagues as possible to stay and ask questions. Thank you.
Okay, with that, let's vote.
Dababne?
Aye.
Dababne, aye. Allen? Asajian? Bonilla?
Aye.
Bonilla, aye. Brown?
Aye.
Brown, aye. Chow? Gatto? Gatto, aye. Hadley? Hadley, aye. Kim? Kim, aye. Lowe? Lowe, aye. Ridley Thomas? Stone? Stone, aye.
The bill is passed. Do you want to read the vote count? Well, should we leave it open? I don't know. That's up to the chair, whether you want
We'll
to.
leave it open for people to add on to.
Okay, thank you.
Yeah. Thank you, Ms. Bonilla. Might be a record for quickest ascension to chairmanship. Thank you. Okay. Let's see. Yeah. So now we will begin the informational hearing today on payday lending industry. The appropriateness of short-term subprime credit has been a contentious and ongoing policy debate in this committee for over a decade. When I became chair, I decided that I will focus my attention on reforming the California Finance Lenders Law for a variety of reasons that I've outlined to many of you the past couple months. I'd like to also welcome our Vice Chair for the year, Travis Allen.
Thank you very much, Mr. Chair.
Small dollar non-bank consumer loans are often the only option available for someone in need of credit in our communities. The research and data reveals that struggling borrowers do not have access to the same credit markets as most consumers. The options for a person with no credit file or a damaged credit record are not ideal. Millions of consumers use payday loans and the other types of products offered in this marketplace, and hundreds of thousands of utilizing these loan installments every month. Just a few days ago, PricewaterhouseCoopers released a report on the financial health of millennials. The report is stark. It reveals that 50% of millennials don't have an ability to come up with $2,000 if an unexpected need arose within the next month. 30% of millennials are overdrawing their checking accounts. 53% carried a credit card balance for over 12 months. And 42% use an alternative financial product such as a payday loan or a car title loan in the past year. What does this mean? It means that a generation that is more educated than its previous generation and aspires to achieve more than their parents and grandparents are struggling and often rely on non-traditional sources of credit. The need for credit is not disappearing, it is increasing. Over the next year, the Consumer Financial Protection Bureau is expected to release rules regarding short-term and long-term credit. These rules will require us to make changes to our consumer lending laws here in California. The need for consumer credit and the pending CFPB action inspired me last year to host a series of stakeholder meetings, which I'd like to thank my colleagues and all the participants that are here today for engaging in. These reforms to California's consumer lender laws has brought us here today. This hearing is a chance for many stakeholders to educate this committee on their thoughts concerning the reform efforts. Stagnated wages that have, for many working Californians, not increased since the recession, the high cost of housing and education are creating a tremendous strain on low to moderate income families throughout our state. These strains can generate a need for capital that is often not available from mainstream financial institutions. Many of you have asked me, what are my thoughts on reform, or what key issues will we take on in this committee? As I've said before, I believe all options must be on the table. However, my goal is to achieve a fair and transparent loan market that balances consumer affordability with return on investment. In achieving this goal, I believe that we must have loan standards that are universal regardless of loan size. We must have a consumer lending law that gives consumers multiple options and ensure that licensees can innovate and continue to make this marketplace more consumer-friendly through technology. This hearing is one of the first steps to hear from lenders, consumers, and community groups on the current condition in the market and their suggestions for moving forward. As you'll notice, we have a very large agenda. I will ask each speaker to keep their presentation to 5 minutes or less. You get no extra brownie points for hitting the 5-minute mark. We will then move on to questions. If your testimony overlaps with another in the same industry, I will allow a witness to give their time up to others, especially experts who are here from out of state. I want this hearing to be conversational and interactive. I encourage my colleagues to ask questions of the multiple witnesses, and if need be, we will invite others that are here to join the discussion. With that, I will tell you, this past week we sent out an email throughout my district asking people what their experience with these types of loan and financial products were. And 2 stories stuck out to me, and I'll just quickly go over them. I won't go into too much depth because I want to leave time for our testimony from our panelists. But I think they're very indicative of the nature of these loans. The first was a student who said that she took a loan out because she couldn't afford the books at that moment. Her student loans were about 2 weeks delayed because of an error. She didn't have family she could rely on. She didn't have a credit card. She had no other options at that moment. She took out a payday loan. She got $255. She bought the 4 books she needed. 2 weeks later, the money came into her account from the student loan processing service. She paid off the loan. She said it was a great help. Otherwise, she would have been 2 weeks behind in her studies. In that case, she had high remarks. Another story that came in was from actually faculty at a local community college. She took out the loan for a car repair. Unfortunately, it spiraled into a debt trap for her. She took out 8 more loans in the next 4 months from various different providers. She ended up in a position where it caused her great grief because towards the end of the cycle of debt, she realized she wasn't using this for a one-time emergency, but just to pay monthly expenses, her cell phone bill, extra expenses that before she was able to balance her budget with. But because of these loans, she was not able to reasonably figure out how she could get out of that debt trap. So you can see the two different usages of these products and how they can have widely different determinants on people's lives. So with that, I will open it up to our first panel to join us, and we look forward to having what I think is a civil and engaging discussion for the next couple hours on this subject. Thank you. First, I'll be Jan Owens, Commissioner of the DBO. I should say, before I start, would the Vice Chair like to make any remarks or any of my colleagues before we start?
Good afternoon, Mr. Chair and members. This is on? Great. And Mr. Vice Chair, hi.
Good seeing you.
And you. I'm Jan Owen, Commissioner for the California Department of Business Oversight, or as you heard mentioned, DBO. As always, thank you for an opportunity to share some data and thoughts on small dollar consumer lending in California. The DBO regulates companies that provides the financial services which are subject to today's hearing. They are non-bank lenders. And at last count, we licensed roughly 2,500 of these companies operating in 7,000 different locations. And that's both the consumer finance lenders and payday. It is our job as their regulator to examine their books and records, hold them accountable, and get consumers' money back when these companies violate state laws and regulations. Small dollar lending touches millions of Californians. And everyone has a stake in the job that we do here at DBO and the policies adopted by the legislature. The chair asked me to provide the committee with data on small dollar lending, as well as recommendations to help guide the legislature's deliberations on whether and how to make modifications to this crucial market. A few introductory points. The data I discuss and contained in the annual reports are submitted by the lenders to the DBO under the state's payday lending statute and California finance lenders law. These two laws that govern the small dollar consumer lending in the state. This data is unaudited. That fact should always be kept in mind when the data is used during policy discussions. Also, this data only covers licensed lenders. It does not reflect unlicensed lending activity. You also have a document with charts that reflect a lot of numbers that I will be highlighting today. Please don't use the charts to follow my testimony. It's additional information that I thought you might find interesting. When a lot of us think about the market for consumer loans under $2,500, we get the image of a comatose patient, just barely alive. But the data indicates it's not all that bad. We look at trends starting in 2011. Loans made under the CFL Small Dollar Pilot Program are under $2,500. Participating lenders charge higher interest rates, but must comply with lending rules that don't apply to normal or regular CFL or consumer finance lenders. In 2014, pilot program lenders made 164,000 loans. That's more than double the 2011 total. The combined principal on the pilot program in 2014 was $180 million, an increase of 84% over 2011. In 2014, CFL licensees reported, and that's non-pilot program, 346,000 unsecured consumer loans under $2,500. That was 34% higher than 2011. The combined principal on 2014 loans under $2,500 totaled $244 million, and that exceeded the 2011 data by 27%. These results cannot be dismissed. They do represent meaningful improvement in a small dollar lending market. However, there's always a but. The picture of under $2,500 markets gets gloomier when viewed in the context of all consumer loans made under this Consumer Finance Lenders Law. While the number of unsecured consumer loans under $2,500 went up by almost 34%, the combined principal increased by 27%. Here's what happened on the larger loans between 2011 and 2014. For unsecured consumer loans of $2,500 or more, the number of loans in 2014 was 265% higher than 2011. The combined principal, again for loans over $2,500, was almost 668% higher. For all non-mortgage consumer loans, both secured and unsecured, of $2,500 and more, the number was 140% in 2014. I'm sorry, 140% higher in 2014 than 2011, and the combined principal amount was 129% higher. Auto title loans. The chair also requested data on auto title loans. We started requiring separate reporting of those loans in 2011. The number of loans for the period of 2011 to 14 went from 38,000 in 2011 to 106,000 in 2014, an increase of 179%. The combined principal grew from $134 million to $382 million, up 187%. For borrowers, auto title loans can be one of the most expensive of all consumer loan products. In 2014, according to annual report data from the lenders, 92% of auto title loans had APRs of 70% or higher. More than half had APRs of 100% or more. Payday loans in California. The payday loan market of transactions of $300 or less has swamped the $2,500 installment loan market for years. 2014 was no exception. Payday loans numbered 12.4 million and had a combined dollar amount of $3.4 billion in 2014. By comparison, unsecured consumer loans under $2,500 numbered 348,000, with a combined total of $244 million. That being said, if you look at the annual report data over the longer term, the payday loan market comes across as sort of sedate when it comes to growth. In fact, during the economic recovery, the payday sector growth lagged far behind the under $2,500 installment loan market. From 2011 to 2014, the number of payday loans remained about the same, compared to a 34% increase for consumer finance lending law installment loans under $2,500. Over the same period, the combined dollar amount of payday transactions only increased by 3%, compared to 27% for the loan product under $2,500. The payday trends are fairly flat over a longer term as well. We started collecting loan data in 2006. Here's the annual report shows the number between 2006 and 2014. Number of transactions increased by 23%. Combined dollar amounts increased by 32.5%. Another trend that hasn't moved much is the average number of transactions made by each payday customer in a 12-month period. Since 2006, that number has hovered in the range of 7 to 7.5 transactions per customer. The transactions per customer provides one indication of what critics of payday call the debt trap problem associated with payday. Along these lines, there's another data point you may find interesting, again coming from our annual survey. In 2013, California payday loan customers who took out 10 or more loans exceeded the number of customers who took out just one loan.
Can you repeat that?
Yeah, exactly. In 2013, the number of California payday loan customers who took out 10 or more loans exceeded the number who took out just one payday loan. And the numbers include 560 customers took 560,000 customers took out 10 or more payday loans, compared to about 225,000 who took out just one loan. Online lending. We don't have much data on online consumer loan borrowing at this point. With respect to marketplace lenders, we hope to have more data coming in March. We launched an inquiry into the marketplace lending industry last month in December. To start that inquiry, we sent out a survey to 14 lenders seeking data on their lending activity nationally and in California. The responses are due to us March 9th, and we plan to publicly disclose the data in aggregate after careful review and analysis. We do, however, have a sense of online activity in the payday loan sector, again from data reported in the annual reports. Only a small number of payday lenders report conducting transactions on the internet, about 7% of the lenders. Payday lenders that conducted online activity reported making little more than 1.6 million transactions, with a combined dollar amount of about $445 million. The reported online activity, however, accounted for 12% of overall payday transactions in 2014 and 13% of the overall dollar amount.
Would you mind if I interrupt to ask a quick question there? You just mentioned that only 7% of the online lenders had reported transactions?
So, no, of our licensees on payday, the payday lenders that do online business say it's only 7%.
Okay.
They're 7% of the number of licensees.
And 7% generated 12% of their total?
Correct.
Got it.
The chair also asked for some numbers on the CFL licensees' compliance with statutory requirements to file annual reports. 80% of our licensees, equals about 1,735, filed their 2014 report by the due date of March 15th, 2015. 450, or 20% of our licensees, did not. We have a statutory requirement to revoke licenses for those who fail to file their annual reports. There is a 10-day grace period, and last year, after the 10-day grace period, 399 licensees filed their report, and we revoked 51 licensees last year for not. The chair also asked me to talk about thoughts on reform. As you know, as a regulatory agency, we are here to assist the legislature with technical assistance and our technical expertise. I want to start by talking about an empirical foundation that we think is very important as we go through this. Millions of Californians have a financial stake in the work that you're doing here. That's why we think it's very important that the reform effort be based as much on evidence. So if you're a lender, you should have to do more than just say you can't make it work with a 36% APR. You should provide the data to back up that statement. If you're a consumer advocate, you should have to do more than just say the certain rate is too high. you should submit evidence to support your conclusion. If you're on either side, you shouldn't be able to get away with simply saying that won't work or it can't work. You should substantiate your position. It's easy to fall back on what we've said for years and years, but we don't believe that you can successfully build quality reform on that kind of foundation. And before we talk a little bit about specific reforms, I do want to talk a couple minutes about the CFPB. You can call the Federal Consumer Finance Protection Bureau a comforting presence, you can call it a specter, or you can call it a dark cloud. The CFPB, however, looms large. The agency currently plans to release its formal proposed rules governing payday and small dollar installment loans in the first quarter of this year, as stated previously by the chair. The rules then go out for a 90-day public comment period, and then the CFPB has to analyze those comments before issuing a final rule. That can take anywhere from months to years. And the final rule most likely will have a 1-year implementation time frame. Under a best-case scenario, we're looking at late 2017 before any rules would take into effect. Most likely, it will be later than that. Why is the CFPB so important to your deliberations? Because whatever they come up with will have a national application, and the rules will preempt state laws unless those state laws are stricter. So let's say the CFPB issues a formal rule proposed in this quarter. Let's say it's pretty restrictive, maybe more restrictive than a lot of proposals that you will see as being a legislator in this committee. If the legislature wants to adopt a more lenient approach, it would run the risk of seeing its work ultimately negated by a stricter CFPB rule. So the CFPB is going to present the legislature, you all, with tough, fundamental choices about small dollar lending reform. Reform principles to consider. We would like to talk about a stronger, more comprehensive regulatory scheme. An example would be examination cycles codified in statute. Currently, there are no cycles for the CFLs in statute. Debt trap prevention, ability to repay, establish clear underwriting standards, and require their use by lenders. Multiple loans, limit the ability to have more than one outstanding loan at a time. Building credit, require lenders to file reports with credit reporting agencies. And finally, reward performance. Adjust interest rates based on borrower creditworthiness and past repayment performance. Thank you, Mr. Chair and members. I'd be happy to try and answer questions. That being said, there's a lot of data, and I know you've got a full schedule, and I know I went over my time, and I'm sorry, but I would promise to come back and answer any questions.
You would never put time straight on the commissioner.
Yeah.
With that, I will go straight to my colleagues,
I just have a question.
Senator Brown.
You said that that these agencies do not have to report right now to credit agencies. They don't have to,
So on payday, payday they don't have to report to the reporting agencies. Is that your question?
Yeah. So a person that needed to have credit but really wasn't, say they're not a good.
So on payday, it's considered a deferred deposit transaction, so it's not considered a loan in California law. And at this time, some companies may be reporting those. At this point, it's not required in statute.